invest, this is one thing that we do a little differently than most advisors, is I'm not picking 10 companies. So I don't have to know everything about those 10 companies. And it's not because I don't want to do the work, it's because there's no value to that. Like I can't add value by picking a company versus a company or a country versus a country. So when I buy emerging markets, I buy all the emerging markets. I buy the whole market. And so when I buy the whole market, when one emerging market country has a problem, another one does well. And on net, there's going to be a roughly 5 or 6% global consumption increase on an annual basis, roughly. And companies that do really well are going to benefit maybe 9 or 10% of that. And companies that do poorly are going to lose money or maybe get 1 or 2% of that. So I'm going to buy the whole thing. So this is the whole market. This isn't the S&P 500, this is the whole market. This is every stock available in the market, okay? So when we diversify, well, okay, this is the S&P 500. How the S&P 500 picks what you own is they say, okay, biggest 500, and then they cap weight it. So they say, we're going to put the most money, notice how it's tilted, this is the amount you invest in each company. Down here, just a little investment. Up here, Apple, Microsoft, Exxon, big investments, big companies. So the S&P cap weights it, okay? That's one way to slice it. There's a lot of ways to slice it, okay? So what we're going to do is we're going to look at the academic research and we're going to say, what is it that gives us long-term higher returns? It's not cap weighting, okay? But there are things that do. So we're going to look for higher expected weightings or higher expected returns, and we're going to weight those things, okay? We're going to be overweight to those things with higher expected return. Okay, there are 4 in the equity markets. And there's been an enormous amount of research. One of the slides up here is going to show you the academics that have done the research, okay? The 4 are market. There's an equity premium. Stocks outperform bonds over long periods of time. And we've seen this many times here. Company size. Small companies outperform large companies over long periods of time. Relative price. Value pays. Buying a unit's worth of earnings for a lower price gives you a better long-term result, right? So in the parlance of the portfolios that we're building, right now, if I have more money, I put it in emerging markets because I can get $1 worth of earnings for $12. In the US, I get $1 worth of earnings for $17. Profitability. Companies who are more profitable now have a tendency to maintain that profitability over time, okay? Those 4 things, and thousands of things have been tested, and there are probably 400 different ETFs on all of these other things that have been tested that have failed the test. But who cares? Let's just build an ETF and sell it to the public because the public is stupid and they'll buy it anyways. And no joke, there are hundreds and hundreds and hundreds of ETFs that have these smart beta. Smart beta is a thing, and money is flowing to smart beta. Okay, so what's market? Market is the whole thing. So buying the market, 4,000, 5,000 companies in the US, the whole thing. But we're going to tilt to smaller companies. Everyone know the Morningstar style boxes. So up here we've got large companies. Down here we have small companies. Okay? On this side we've got value companies. On this side we have growth companies. So we're going to focus on smaller companies, the smallest of the small. We're going to focus on value. Notice how this gets on the very bottom, it's even darker. And over here it gets darker still because this is small and value. Okay? And then we add profitability. And guess what? Some of these companies are very profitable and they have a tendency to be, so we're going to add those back in. We're going to own, if there's 5,000 and we put these filters on it, we're going to own 4,500 of the companies and we're going to tilt them in these ways. We're going to own more of the companies that show us these kind of statistics, okay? Face to face, they've done the research on this, and this is the percentage of time this is successful over time. And I'm just going to quick flash all 3 and come back to this one. This is the US. Notice the similarity of the graphs. This is developed, ex-US. This is emerging markets. So very similar graphs, okay? Let's go back to US. What this is saying, and there are criteria for these 4 to be considered successful. The research went through 5 elements of criteria. 2 of them just come to mind really quickly, the other 3 I always forget. They are geography and time. So look over the entire period the US markets have been in existence, pre-S&P, Dow Jones, when there's just the whole period of the US markets, and look at the whole period of emerging markets and the whole period of, and they look at different geographies, and they say, okay, these 4 things work across time periods, across geographies. They are persistent benefits, these 4 issues. For 1 year, 69% of the time, the US equity market beats T-bills, 69% of the time. Over a 15-year period, it's 96% of the time, okay? So that's the market premium. Value versus growth. Over 1 year, what is that, 61? 61% of the time, value beats growth. Over 15 years, 97% of the time. But what this means is 39% of the time it fails over a 1 year period. So guess what happens when the thing fails? People leave and go do something else. Guess what that does? It's the thing that creates the opportunity for those of us who stay. Yep. So whether it's small beats large, high profitability beats low, value beats growth, market beats T-bills, it's the same concept. And I'm going to go back to this one. Eugene Fama in the University of Chicago is the one who's really driven this home. But it starts with Markowitz, who's a Nobel Prize winner, and William Sharp, who's a Nobel Prize winner. Fama won the Nobel Prize last year, or 2013, sorry. And this is taking the global marketplace and figuring out how we can actually honestly do better than the market, right? The behavioral part is sticking with it to get there. How do you stick with the plan? You got to believe when it's not working. And it's not working right now, right? The S&P is doing better. I'm okay with that. I'm going to keep doing it this way.